This conference will now
great.
be recorded.
Good afternoon, everyone. It is Friday, May 15th at 12 noon, and we are thrilled at Agency One to bring you the continuation of our weekly WebExes Monday, Wednesday, Friday, trying to make sure that everybody is connected during this pandemic and stay-at-home orders that we're currently still under in various states, regarding, I guess, where you live. Today, I am thrilled to bring you Prudential, and we're going to be talking about the pandemic protection products and possibilities. My partner, Gonzalo Garcia, is going to be leading the discussion with our featured speakers, Kevin Brayton, who is the Vice President of Independent Life Insurance Sales and Distribution, and Tom Farrell, who is currently the Vice President and Chief Underwriter at Prudential. I am going to remind everybody that if you would like to ask a question, please type your question into the chat box, and Gonzalo will do his best to address the question with our panelists either during the presentation or once they're done their conversation. And we also have some important announcements regarding what's going on at Agency One and what you can expect to see next week. So what I would ask that once the presentation is over, please stay on the line so you won't miss them either. And with that, I'm going to turn this over to Gonzalo. Take it away.
Well, good morning, everybody. We are thrilled that it's Friday. It's been a long week, and more thrilled to have Tom Farrell and Kevin Brayton with us from Prudential. I've known both these gentlemen for a long time, and their leadership at Pru is really driving some amazing results. But we're going to kind of jump right into, what people really want to hear. And of course, I get an awful lot of questions about, and some of this has been covered. But your perspective on things like mortality and COVID, number one, and kind of what's going on relative to the low interest rate environment. And Tom, maybe we start with you on, everybody's worried about COVID. Everybody's worried about increased mortality. I mean, you guys have a pretty broad-based risk exposure in your pension risk transfer business, which is longevity risk. You've got an old long-term care block on the books. How do you, just kind of big picture, where are you seeing mortality relative to Prudential and the impact on Prudential, and how are you balancing that out?
Okay, maybe I'll start on at least on the life side, and then Kevin, maybe I'll ask you to jump into the more broader picture from an enterprise level, if you don't mind. So from the life side, I kind of kid everyone by saying that it is definitely a balancing act. I sometimes feel like I'm Gumby. I have Kevin on one side pulling at this arm, telling me to get sick, and Kevin's a big guy. I have the chief actuary pulling the other side, telling me to watch mortality. So I'm caught kind of in the middle. But the bottom line is that underwriters been around. Kevin's team is not successful in selling, so we try to do everything in our power that we're offering him the support to facilitate sales. I believe the approach that we have put in place has put us in a pretty good position to facilitate sales during this period and kind of protect against the higher risk groups. And briefly, how we're doing it is really a common sense approach. You look at the data coming out of the virus. We look for opportunities to identify the healthier risks at lower face amounts in younger ages, because if you're healthy and you're younger, the data shows that even if you get the virus, you're recovering. So we kind of have taken advantage of our accelerated underwriting program and try to put as many risks as possible through that program. We've increased that face amount up to 3 million to try to, a little bit more sales through it. And we discontinued the need for exams and labs where possible for ages 60 and under at amounts 3 million and under. But at the same time, the balancing act. So the data also shows that there's a lot of high exposure areas. So if you follow the facts, what we've done is pretty much put those controls in place to try to mitigate early claims and mortality down the road. Age 80 and over have shown that there's a double-digit mortality rate, so we've stopped temporarily sales at that age group. Comorbid conditions, so if someone presents with a history of diabetes, coronary disease, cancer, and they're over the age of 60, again, the data supports that if they get the virus, they could be in trouble. So we're kind of watching that scenario as well. And then finally, any case with chronic respiratory problems do seem to have problems.
Yeah.
comment on our in-force block, and then I'll let Kevin jump in, is so our in-force block, we obviously are seeing claims. We're seeing claims come in the door. We're a large carrier. We have a large in-force block. But so far, what we've been seeing is pretty much what we've expected. You're seeing a lot of older age claims, a lot of older age cases up on our legacy platform. So the cases that are coming in are cases that have been on the books for a long time, so or on older ages. So the impact hasn't been that bad so far. There has been no real large claims, and there's been really no current claims as well. So Kevin, I'm not sure if you want to jump in with the rest of the enterprise look.
Yeah, I'd love to hear kind of the balancing act with the longevity and morbidity risk as well, because we've talked about that a lot, Kevin, and I know that's meaningful.
Yeah, we have, Gonzalo, and thank you. First of all, thanks for having Tom and I on today. Really appreciate the opportunity, and thanks for all the business that we do with Agency One and all of the fine producers today. So, the balancing act that you're talking about is what I would refer to in our business at the enterprise level is we try and create natural hedges between mortality and morbidity. We try and create natural hedges between where the earnings power of our businesses come from, whether it be from international markets or domestic markets, whether it be from mortality and protection type businesses or morbidity and longevity type businesses. So you see that naturally happening across our business. And granted, certain businesses like the annuities business, for example, while it's a longevity business, we very much complement each other's businesses because the more longevity power that they have and the earnings potential that they have for our enterprise and what that earnings power does to drive our stock price is really important for us to counterbalance that and put more mortality on the books. And,
right.
Take the cash premiums in and use that as a cash cow and driver of a lot of our internal initiatives and stuff like that. You also see that, particularly, you mentioned the PRT business. So. Right. Quite a while ago, we got into the pension risk transfer marketplace. That is a very, very big market with an unseemingly endless supply of opportunity that we have in that marketplace. Now, when we take those on, immediately when we take on those longevity risks and we take on those pension plans to manage those pensions on behalf of those large businesses, that immediately goes into runoff mode the day that we take that over. So right. What we have to do is we have to counterbalance all of that longevity and all that runoff business coming off the books with longer duration, longer payment stream type solutions, which is the perfect opportunity to sell life insurance. So when you think about it from Prudential's appetite to take on or Prudential's appetite for the life insurance business and how truly important the life insurance business is, we have created all of these natural hedges in our business and all of these symbiotic relationships between our businesses, whether it be the retirement business and life or annuity and life or international and the domestic life business. They all are very complementary and fit together very nicely as a puzzle, which is part of the way that we manage our business and manage our company is through those hedges.
Yeah, so let's just expand on that for 1 second, because it may seem real obvious to you because you deal with this and you're entrenched in it all the time, but when you bring on XYZ publicly traded company and they have $20 billion worth of liabilities for their pension, and they send you guys a check and say, okay, you guys run off this whole annuity block and you paid the benefits to these people, right? That creates a very long longevity risk for you guys, right? Which right. Then brings the appetite for we need mortality risk. So the more PRT business, pension risk transfer business you guys do, the more appetite you have for life insurance business. And you guys are constantly balancing that out, which is one of the beauties of Prudential, one of the big successes you guys have had.
Yeah, it's well said, Gonzalo. In fact, I wouldn't add much more to that other than the fact that, we have these leverage ratios that we want to, kind of manage within, and we believe these ratios of the amount of PRT business that we take in on one side and the amount of life insurance mortality that we want to capture on the other side. Right. we manage very closely our capital positions within those parameters. So yeah, I mean, basically one fuels the other, and both are more successful naturally as a result of individually being in both of those businesses.
So when people say, is Prudential committed to the life insurance business? The answer is, you said there's an unending appetite for the pension risk transfer business.
Yeah.
I think the answer is yes, right?
Absolutely. Yeah.
Absolutely. Which is great.
Core to our business, core to our strategy, core to our financial wellness. I believe that, when you have life insurance ownership rates in the 40s, there is certainly a ton of upside for coverage opportunities in the life insurance space. So it's core to who we are and what we do.
That's great. Tom, I want to get back to the issue of mortality, and we'll just take a minute on this, because I think, a lot of people have commented that, well, there's millions of less people driving, so car accidents are down, and, the murder rate is down, or, whatever. There's all these impacts from COVID that have also decreased mortality in other places. Is that just anecdotal? I mean, is there any fact to that? Are people saying, okay, the morbidity of COVID may be impacting us in some way, but we're getting gains in other places? Is that something you guys look at, or is it just kind of people talking because they don't have anything else to say?
Yeah, I think they're trying to rationalize that the COVID's not going to be that bad of an experience on the overall population. I hear the same. I'm not sure I'd go that far. I think the COVID the COVID has escalated claims probably more than we've expected or anticipated. Right. Yes, people are driving less, so it's down a bit, but it's not an apples to apples comparison. I don't think you can correlate the two and say that we're going to break even at the end because of that.
Yeah. Okay. Well, that squares that up, because I've had that question probably a half a dozen times in the last month. Kevin, back to you. The low interest rate environment. I mean, this is, COVID obviously is causing a mortality issue, and it's a big concern. But when you've got 10-year treasuries under 1%, I mean, it's putting an inordinate amount of pressure on the insurance business relative to product pricing and long dated guarantees and so on. And, you guys were one of the first ones to say, what, we're out of the 30-year term business. And that kind of, raised some eyebrows, right? Got a little bit of a reaction from people. It's like, okay, now what? And it's even been in the press. I mean, it's been mentioned in the press as a bad thing. So I want to give you the opportunity to comment on that, because again, it goes to your commitment to the life business. It goes to your commitment on, judicious pricing and making sure you're running a sound business for the benefit of all of us.
Yeah. So good point. So I would just caveat that and say we are temporarily out of the Term 30 business. We are reintroducing our Term 30 product in early July. So we did have to step out of that marketplace. Unfortunately, for every dollar of sales in that product under that interest rate environment, given the way that we had structured that product and given the new reserve requirements under PBR pricing regimes, candidly, we had plans to get under the hood on that product in June to do some repricing anyway. But unfortunately, with the low interest rate environment and where that was, it created a scenario for us that was really ugly for the 2-month period leading up to June. So basically, every dollar of sales we were putting on, we were losing far more than $1. So we made the tough decision to pull the Term 30 product temporarily out of the marketplace. We'll get back under the hood on that and release it. That'll be much better for us to sell. Certainly less competitive from a pricing perspective, but we'll be back in market in July with that product.
Got it. Great. So on pricing, you also had an increase in your GUL pricing, but you have not had an increase on your VUL pricing with long dated guarantees. So, talk about those two products, because I think, there's been some other companies that increase, 20%, 16%, et cetera. Not to call anybody out, but everybody knows who they are. So where do you guys fit relative to kind of your long dated guarantees on your fixed business? And, because you and I have had many, many conversations, you guys have a keen interest in the variable space as well. So kind of where are you moving relative to permanent product?
Yeah, so good question. I think the capital challenges and the low interest rate environment and the capital requirements for a fixed long duration guarantee product, let's call it GUL, that is very, very challenging in this environment. Not only is it challenging because of the low interest rate environment, but it is very challenging from a market volatility environment. You got to protect yourself against potential capital calls in this type of an environment. But also PBR and some other, I believe AG 48 had eliminated the use of captives. So the whole idea of efficiently funding redundant reserves in long duration fixed UL products has not been very favorable. So the capital that is required is far more than before, and the capital that you have to go out and to back those reserves is far more expensive. And then you add the risk of market volatility and capital calls, and then you add the low interest rate environment on top of that, and it's a really bad recipe. So that's how we have to get to that point of raising pricing on GUL so that we can afford to return shareholder value there. As it relates to VUL, the flip side of that, though, obviously different actuarial guidelines and reserving requirements for each of those products. Number one, shifting a lot of the risk on the investment performance to the policy owner certainly helps. But in our scenario with our GVUL product, we actually build up a substantial amount of cash value. So if you think about the guarantees that are provided in the contract, you have the secondary guarantee, the natural guarantee that's built into the contract, and that's fueled by the cash value growth. And then you have the shadow account guarantee, which is a secondary guarantee. We hope to never use or get to a point where the values in the contract are so depressed that you have to rely upon the secondary or the shadow account guarantee. But that's where, when you look at our product in the VUL space and why we're so comfortable with it and why we don't anticipate any changes in that product in the short run, is because we build that cash value up. It provides a layer of insulation against the capital call or against the need to dip into the shadow account to provide the long duration guarantee. So the more cash value we build in that product, supports the base guarantee within the product.
Well, I want to do a quick call out here because for the folks on the call, I think it's really important that they understand this, and it's a real opportunity, I think, for you guys, Kevin, because there were three guaranteed VUL products in the market, to my knowledge. And again, everybody knows who they are, so not to name other carriers by name, but one had a 15% increase in their pricing. The other had a 16% on average increase on their pricing, literally just this week. So what I'm hearing you say, and I'm not going to hold you to this, obviously, but it's you don't anticipate any price increases on your guaranteed variable universal life as we sit here today. Is that a fair?
That's correct. We in fact, we have one improvement slated. We map out our product calendar like everybody else. In fact, I just got off a phone call before this where we were talking about the product calendar, and we do not plan on touching our VUL portfolio until second quarter of next year. What we will be adding in July of this year is a survivorship benefit to our SVUL product. So we're going to add some things to that, which is really good. And we're doing some things to round out. I know one of the questions you might ask us is around our Life Insights. We're going to do some things to round out Life Insights and some of the complementary things that help support a VUL sale, but nothing in terms of pricing at this point in time.
Great. Well, we're gonna get to Life Insights here in just a minute. I want to bring Tom back into the conversation. We've been listening to way too much of you, Kevin. So let's get the smart guy on the phone. Sorry, that was not appropriate. Tom, you guys, you mentioned it before. There was a pretty meaningful increase in your fast track underwriting to $3 million. It's not just on term, it's on all products. You're doing also a digital end-to-end experience with e-interviews as opposed to tele-interviews. I mean, you're doing a lot of stuff. And being on the advisory council of Pru, I was privy to some of this, and we've been talking about it for a year and a half or two. And all of a sudden, within 2 months, it just all came out. I mean, clearly this isn't something that you guys pulled out of your hat 2 months ago. So talk about that a little bit, because I think, beyond most people, you guys have really been very helpful and very proactive on your fast track underwriting. So talk a little bit about how that's working for you.
Sure. So, and real quick, I want to just circle back to the question on mortality, Gonzalo, because there's another concern there that I think everyone at least should hear about. And, you have a couple concerns that aren't even related to the virus, from a mortality standpoint. You have unemployment at the highest rate, which is a stressor in itself. People might not be able to afford medications that they need to, keep their impairments going and control. That's a concern. People stuck in the house is a concern, that need an outlet. So there's a lot of things that you worry about besides just getting the virus in this pandemic that I think, to answer your question from before, the mortality is going to be higher than people expect because there's so much more involved here. So just wanted to put that out a little bit.
Yeah.
Back to the question. So yeah, we raised it to 3 million as an answer to this pandemic, but that has been on our radar pre-pandemic for a while, and we've been watching the results come in. The pandemic just made it happen quicker. Historically, about 6 to 7% of our overall volume fits between the amounts of 1 million and 3. So it's not a great volume, but it's definite enhancement if we're able to get there. So, and my thought has always been that if you're trusting your engine, your accelerated underwriting engine, to make decisions on $1 million of face, that's a pretty hefty death benefit to pay. You better be confident that at 3 million, it's going to do the same job. So to answer your question, I think, coming out of this, we're going to probably make recommendations to make it a permanent solution. We'll have to get all of our reinsurers on board with that and show them the results and why we're confident. We've been in this 4 years now, so we have we definitely have the volume to show that it works and that we're confident. The other part of this, as you mentioned, the e-capabilities. So we've introduced an e-interview, which takes the place of the call center call on the kind of the phone call interview that we collect data on. That e-interview, and if you haven't used it, and anyone on the call that hasn't used it, I urge you to go take a look at it. It's available 24/7. 30 to 40% of our clients are using it on Saturdays, Sundays, holidays, when the call centers are closed. It's very interactive. And what we've done recently, and partially because of the pandemic, but it's going to really pay benefits moving forward, is we've added drill down questions. So if you tell me you have a certain impairment, it starts asking drill down questions, which gives us more data. And the more data we get, the better the engine is. And possibly we'll make decisions without, the use of medical records, without the use of an exam or blood information we collected on the client interview. So definitely we're seeing a big uptick in the use of the e-interview across the board. We need more cases to come through accelerated underwriting. We have success stories left and right with policies being issued in hours, policies being placed in a day, and even same day placement. So I can't see why anyone would go back, in all honesty, to paper. Right. This is the future. Get everything done with capabilities, and we have the whole suite, so you take advantage of it.
And I was just going to say that this is not just term. So Prudential has all your products except, I think, your survivorship on Fast Track now, right? Is that a fair statement?
That is correct.
Yeah,
every product is available, same parameters.
Got it. On e-interviews, on the drill, when again people are doing it, you can start and stop. You can do it in the evening after the kids are in bed. You can do it on a Saturday. To your point earlier, are you experiencing higher placement ratios with e-interview versus tele-interview? I've heard that from some companies that they're having a better placement ratio with the interview, or better success with it.
Yeah, you're seeing better. You're not only seeing better placement rates, you're seeing less requirements for medical records. You're seeing quicker cycle times, so you're seeing quicker start to finish. And it's because there's more data being collected, which gives the engine the power to analyze it. Again, from a Prudential standpoint, it costs us nothing. So from an expense standpoint, it's outstanding for us. But from a consumer-friendly tool, I don't understand why anyone wouldn't use it.
Got it. So you also mentioned early on the call today that you were I don't want to say waiving exams, because I think it's important that people understand that, it's not just we're waiving them, we're just getting information in a different way. But I think you guys have adopted some other technologies, possibly human API. You might be looking at Claretto and other platforms that are going to really drive that data in, so you guys are making judicious underwriting decisions. So can you talk about some of the other tools that you guys are bringing to the table in order to expedite the underwriting process?
Yeah, the goal is to use all the available information and not get the exam and blood test where possible. Obviously, it's not going to happen on every case, but for the majority of cases, it's our belief that you can make an intelligent decision based on the tools that are available. So we had been piloting with the Human API, the electronic health records, and then we just decided to go full blown with it. And for those of you who don't know, Human API goes after your patient portal, and then that information comes back in data form as well. Been successful. It's kind of a hit or miss. Human API all of a sudden exploded. They were small, and now a lot of carriers are using them. So we're working all the kinks out with them. But that's the future. The future is electronic health records. We've been very successful. We've been moving a ton of cases through the pipeline, and Kevin can thank me later for that. But the reason is because we're able to get the patient portal. We're using pharmacy records. And what we've done a lot of critical thinking training with the underwriters. Take a step back before you go and think you need an exam and blood, and determine whether you have enough information to make an intelligent decision. And it's working.
That's great. Again, do you see? I think you said earlier, this is the future of underwriting. I mean, is the genie out of the bottle and we're not going back? We can't put the genie back, or, is this kind of the new normal, or is in some form or fashion, are we going to go back to some of the old traditional ways of underwriting after this is all over?
I believe, this is my personal opinion, is that the genie's out of the bottle. I believe we will go to this type of an environment. Obviously, the larger face amount cases are still going to need the additional medical requirements, and that's understandable. But I think it's time that reinsurers get on board with it, and most carriers will probably start taking this approach. I know we're gonna go hard after adopting a lot of things that we believe are best behaviors and best practices. So I do think you're going to see a big change.
That's great. Todd, you mentioned reinsurance, and this was not on the list of things we were going to talk about, but in conversing with Doug Winkler and Tim Eads and so on, they suggested maybe you want to, just position Prudential relative to the reinsurers. You said reinsurers have to get on board with this. Kind of, what do you? I mean, you guys are a big company, right? I mean, you've got a lot of capacity. So how are you interacting with the reinsurers, and how is this all working out for you guys relative to that? Are they putting pressure on you?
No, so we do. We have a tremendous relationship with our reinsurers, and a lot of it is volume driven. We put a lot of business on the books, and we give them a lot of business. We cede to them. So obviously they want Prudential as their client, and they want Prudential happy. At the same time, we work very closely with them to make sure anything we're doing that they're comfortable with in pricing. We don't want all of a sudden their prices to go up, that they're going to charge Prudential more because they're not comfortable. Some of them took very strong stances on capacity. So large case market now is pretty tough. It's tough to get those big cases right now, and that's okay. They'll come back. But I think for the most part, they were comfortable. We went right to them with our plan. And in fact, we were one of the first carriers to go put some mitigants in place, to kind of put our foot out there and say, we're concerned at certain ages, we're concerned with certain comorbid conditions. You see soon after that, a lot of people followed suit. So I think the reinsurers took our action and then went and put pressure on other carriers.
Yeah, got it. Thank you for that. Kevin, let's wrap up with this, because you mentioned LifeInsight a minute ago, and certainly you guys have come out with a platform that is really unique. I mean, I demoed it 2 years ago, and it's been getting bigger and better. And just for everybody's information, LifeInsight is a policy-enforced policy management system. You guys have onboarded most of your products. Now I'll let you talk about that. But in the environment with low interest rates, with volatile markets, with caps, caps on IULs going all over the place, it's more important today to have a platform like that than it ever is before. So why don't you explain to the folks on the call, what is LifeInsight, how it works, and then we'll wrap up.
Yeah, thanks. Appreciate that. So as Gonzalo said, we were hard at work a couple of years ago when we began to shift towards a more variable portfolio and having variable or IUL represent more and more of our sales. We understood the need that we need to put advisor tools and agency tools in place to very easily assess where you are at any given point in time and have a better experience than just getting an in-force illustration. So we built a completely digital tool. We have been feeding our in-force books of business into this tool. So what you get as an advisor is, for example, a summary, which makes it very easy to pull information right off and do your policy reviews with your client to see where they stand. We've provided all sorts of tools and everything to basically do whether it be beneficiary changes, reallocations, and things like that right within the tool. We've put in scenario builders where at your fingertips you can actually build in different scenarios and say, well, you know, this year my customer would like to, you know, split his premiums at the beginning of the year and the end of the year or middle of the year. What does that look like? What's the ongoing performance of the policy look like? And be able to model that out, which is very, very helpful. It allows you to set certain notifications to help it be much easier when servicing your contract. So you can set alerts when there is drops in the market. You can set alerts when there's any changes to the policy. You can set alerts when you know, cash values, you know, potentially dip to certain levels to give you very, you know, clear notifications and alarms as to when you need to act on a policy. And then what we've just announced this week is the newest edition, which is the investment feature specific to the VUL category, where it gives advisors a consolidated way to understand exactly how the policy premiums are being allocated, where the client's money is invested, and then what options they have to manage the entire strategy for the policy that was sold for that particular client.
That's awesome. You know, look, I would be remiss to not suggest that, you know, there's a reason Prudential is one of our favorite go-to carriers. And notwithstanding the fact, and I didn't bring this up when we were talking about reinsurance, you know, we are part of a reinsurance company that's backed by Hanover and LifeMark Re, where we are partners, and a number of folks on the call are actually shareholders as well. So, you know, we have a beautiful relationship with Pru. You guys allow us to reinsure a lot of the risk, or most of the risk, if not all the risk, that we write with you guys. So, you know, between LifeInsights, between reinsurance, between all your fast track underwriting and all the stuff that you're doing on product, and your commitment to the life business, I think that you guys are incredibly well positioned, and I just want to thank you guys for that, for being such a great partner. Do you have any kind of final thoughts on, you know, there's a number of people on the phone that are out there, you know, trying to take care of their clients. We're in a very challenging time. I mean, just some closing comments on where's this business going, and, you know, when is the pandemic gonna, you know, how is the pandemic gonna continue to affect our business?
Yeah, I think I would offer these comments that I've spent a lot of my time talking to producers and customers and agencies and clients and stuff like that over the course of the last 2 months. And while it's really unfortunate around, you know, the pandemic and the market volatility and stuff like that, I do think that there is some silver lining with the solutions that we offer. I mean, I think people are thinking about life insurance planning. I think people are taking action. I think there's a certain level of, unfortunately, fear that drives our sales. But I also think that there's a certain level of tax planning and strategy planning that drives our sales as well. And when you have market volatility and the economy where it is and $3 trillion of stimulus, that's going to have to get paid. It's not going to get paid for by the people that are actually receiving the stimulus. So I think all of that creates really good tailwinds for the life insurance business. And, you know, we're here, we're ready, we want your business, we'll compete for your business, and most of all, we thank you for your business.
Tom, any final thoughts on your end?
Yeah, pretty much echo what Kevin said. I think this is going to wake people up to the value of life insurance. Lessons are going to be learned, best practices implemented, which I talked about. I think pandemic underwriting is going to be a critical part of every underwriting shop moving forward. And we're going to come out of this a lot stronger than we went in it. And I'm confident, as I said before, that everything we've put in place, we're doing the right things to keep the lights on now, support your needs, and we'll be well prepared when better days are ahead.
That's awesome. Well, gentlemen, I can't thank you enough. I mean, it's a rare day. We have, two people like you on a call with us, and I'm just so grateful that you shared this half hour with us. Thank you. Kathy, I'll turn it back to you.
Terrific. Thank you, Gonzalo. Kevin and Tom, thank you so much. This was terrific. Next week, we are going to have 2 WebExes, one on Monday, one on Wednesday in our weekly series. We're going to skip Friday because it's the beginning of the Memorial Day holiday weekend. On Monday, we are going to do a deep dive into human API. So following up on what Tom said, we are a big believer in human API. Agency One is using it, and this is our opportunity to educate our advisors on how this process works, how we can obtain your clients' how we can obtain your clients' medical records electronically. There is a process and procedure to this, so we are dedicating a half hour into a deep dive on human API. And then on Wednesday, we are going to have an annuity update with our friends from Lincoln Financial. In addition to those 2 WebExes, on Tuesday afternoon at 3 o'clock, we have part 2 of our series with Annexus. And this Tuesday, we're going to focus on the Securian IUL product. And again, it's going to be a deep dive for an hour. You should have received an invitation. We will be sending out some follow-up reminders. So if you have not registered, please do so. And if you did not get an email, please reach out to us. In addition, we also sent out a survey asking everybody how they feel about these Monday, Wednesday, Friday WebExes, and whether we could be doing anything differently, topics you'd like to see, speakers you'd like to hear from, what you'd like us to do once this stay-at-home order is lifted, and how often you'd like to hear from us. So if you have not answered the survey, please fill it out because your input is extremely important to us. Those are the extent of my announcements. If you have any comments, questions, or concerns, if Agency One can help you in any way, please reach out to Gonzalo, myself, or your very interested team at Agency One. I hope everybody has a wonderful, healthy, and safe weekend. And we see you again on Monday at 12 o'clock for Human API. Thanks, everybody, so much.
Kevin, Tom, thank you so much. Appreciate it. All the best. Be safe.
Have a safe weekend.
Bye-bye. Thank you.